traders, Gary Wagner here just after 10:30 in Honolulu, 4:30 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the 18th day of September 2015, and this is the daily report for gold and silver, our weekend review. An extremely interesting ending to an extremely interesting week. Of course, we had the FOMC meeting of the month. That took place on Wednesday, concluded on Thursday. Yesterday, announcement made that interest rates will not be raised this month. It is possible to see a raise by the end of the year, but certainly not this month, and that sent the metals strongly higher. As you can see, trading up today another $9. When we look at our daily chart, you can see we've had 3 consecutive days of strong upward moves. We've got an interesting pattern, and it is counter to what you would think it normally means, and we'll bring it up and simply leave it to the discretion of our viewers as what you want to make out of it. But the pattern that I'm looking at, and this is a weekly chart, you can see the market hits these lows at 1080. Substantial support. I believe the low might have been around 1070, 1071 in that area. Then you have the market moves up, and we definitely have some resistance sitting around 1171. So prior to this week, that's this candle here, we've had 3 consecutive weeks of lower pricing. Now, as a matter of fact, if you want to just identify these 3 candles, it's called 3 crows. And 3 crows is simply a bearish continuation pattern, but that was broken by this long move up, which substantially took out the areas right in here. Now, I've just gone ahead and I've pulled up a pattern block, an illustration of what this pattern is like, and it's simply called a 3-line strike. And believe it or not, this is the bearish version of that pattern group. The bullish version is the opposite, in which you've got 3 soldiers moving up. You would get 3 candles moving up, 3 white soldiers, and then coming down. This is actually the bullish version. Now, the likelihood of it properly predicting that the market will come down is actually on our testing rather low. It's only about a 40 to 45% hit rate on this particular pattern. But nonetheless, it's a good match, and I thought we would absolutely start the show by pointing that out, that we did get a pattern called, as I said, a bearish 3-line strike. Now, the only real caveat to this pattern, as I said, first of all, it doesn't have a tremendous predictability in terms of the probability outcome based upon this single pattern. The other thing that you want to realize is that the more this green candle goes and covers the range of these prior 3, the stronger supposedly this pattern is, and it only comes up about halfway on there. But nonetheless, it is a bearish 3-line strike, and I did want to point that out. More importantly, though, and we're going to go to our daily chart, is the fact that we have now traded above what I consider to be our first level of minor resistance. We talked about this a little bit on the show the other day, and that is that the 38% retracement level, and that's a retracement from this low at around, I'll call it 1071, up to the top of this rally at 1171. The 38% retracement comes in at 1133. So that is fairly significant. We have another level that I also believe is a minor level of resistance at 47, because the major level of resistance comes in just below this 1170, which is around 1156, but it's based upon a much longer term study. And the study that I'm referring to is this monthly chart. Now, there's a couple of very, very important things, and there's a couple of reasons that I could get very, very excited about this market. But really, before I do it, I need to see it take out this level at 1156. And what I'm excited about is as follows. With this decline that we have seen over the last couple of years, in which the market has moved from this record top above 1900 to these new lows at around 1070, we can look at the market in terms of the retracement that we've seen. Now, I've got one retracement which really begins at the onset of this strong rally, the leg of this rally, because the way that I look at it, you've got a couple of legs. 1, You've got another leg here, correction, and then this dynamic move up. When we look at that, we get a 61% retracement at 1156. Now, that's important for a couple of reasons. First of all, anything really below, unless we really move above this price point, there's really very little case or very many models that can be a bullish model. However, when we take into consideration the following, in other words, the market has a dynamic move up, it corrects roughly 61%, and then it returns to its bullish move or bullish rally mode. We could look at this in terms of an Elliott wave count, is the potential for the beginning of a nice rally to the upside. Now, this also looks at the possibility that we have concluded our corrective wave, which is that wave 4 down. And if that is the case, traders, we could be looking at the potential for this market to really rally to higher grounds. And that's what I'm so excited about, is the fact that if, in fact, we can see this market trade above 1156, and traders, to me, that's critical. That gives us real confirmation that we've absolutely concluded this fourth wave. And that being said, if that's the case, we can look for higher pricing according to Elliott wave theory. Now, traders, here's where it actually gets a little interesting. What I have done is I have added another fib retracement. Now, this fib retracement really starts from the onset or beginning of wave 3, and this is where the market is trading at roughly a $200 or about $300 per ounce up to this record top. When we calculate the retracement levels, take a look at this, traders. The 50% retracement level comes in at 1092. Let's draw that across and take a look at this particular low, how well that matches. It really tells us that when we look at the picture in a much wider, broader stroke, that what we are seeing here is really the potential for a bottom in this market, a genuine counter wave down, a completion of 4, and the onset of 5. And traders, after we've been through the last couple of years, really since about 2011, 2012, in which we've seen a dramatic decline in precious metals prices, it would certainly be nice to reverse that and to see this market begin to go back to its bullish mode and higher pricing. That would be an exciting thing indeed. This has been Gary Wagner wishing you, as always, good trading. Have a great weekend. We'll talk to you on Monday for another daily update and review. Bye-bye.